If you prepare a lot of individual income tax returns, one of the questions that you're going to be faced with this year is, what did the Tax Cuts and Jobs Act of 2017 change with respect to minor children? The so-called kiddie tax changes would be the first things we should probably talk about. The Act simplifies the tax on the unearned income of children by applying ordinary and capital gains rates that are applicable to trusts and estates to the net unearned income of a child. Now, we should point out that the child's tax is no longer determined by the tax of the parent. The income of the parent, the tax rate of the parent, has nothing to do with the tax we determine for the child. So the unearned income is taxed at trust and estates rates. Now, those trust and estates rates get to a fairly high bracket, 37% bracket, when you get to $12,500 of unearned income. As to earned income, the taxable income attributable to earned income is taxed according to an unmarried taxpayer's bracket. So the minor child is unmarried. I doubt they're going to be filing joint returns at 14 years old. We hope not. But the unearned income is taxed according to the unmarried taxpayer's brackets and rates. The child's tax, as I said, is unaffected by the tax situation of the child's parent or the unearned income of any of the child's brothers or sisters. The Act directs the IRS to promulgate, it's a big word for publish, develop and publish, rules for a due diligence requirement. The Act imposes a new due diligence requirement on paid preparers who are now required to determine the eligibility of the person for whom they're preparing a return to file as head of household. There's a form for that, you may recall. This is a new due diligence requirement that burdens paid preparers for more of the compliance work that I suppose we should assign to IRS auditors, but they're all busy. So we paid preparers are now enlisted and enrolled in the business of making sure that the taxpayer really qualifies for the status that they want to claim. Next, let's talk about the child tax credit, because the child tax credit is increased to $2,000 per qualifying child. However, the maximum refundable amount is limited to only $1,400. There is another credit, a $500 non-refundable credit, which is not exactly a child tax credit, although it could be. It's a non-refundable credit for qualifying dependents that are not qualifying children. If you carefully study the rules for dependents, you'll find that qualifying children are described in one code section, qualifying dependents in another, and if you read clear to the bottom, you'll find that literally anyone who resides in your household for whom you provide more than half of their support qualifies as a qualifying dependent. So my 90-year-old father lives with me. I provide more than one half of his support. He qualifies. That qualifies me for the $500 non-refundable tax credit for a qualifying dependent who is not my qualifying child. The present law definition of who is a dependent is retained, so we don't have to re-educate ourselves on that particular issue. In order to receive the child tax credit, either the full $2,000 or the maximum refundable portion of $1,400, a taxpayer must include a Social Security number for each qualifying child for whom the credit is claimed on the tax return. No Social Security number, no tax credit. That requirement does not apply, however, to a non-child dependent for whom the $500 non-refundable credit is claimed. For these purposes, a Social Security number must be issued before the due date, obviously, for the filing of the return, because you can't put a Social Security number on the return if you don't have it. It just makes sense. That's an interesting rule. You have to have the number, it has to be issued before you file the return. I suppose that you could file an amended return giving the IRS the number, but my guess is that would create some confusion, which would cause you and the Internal Revenue Service to become pen pals. Not a way we want to spend our time right in the middle of busy season. The credit begins to phase out for taxpayers with adjusted gross income in excess of $400,000 in a joint return and $200,000 for all other taxpayers. Those phase-out thresholds are not indexed for inflation. Now, those are the most generous phase-out thresholds in the entire tax law. So Congress wants you to take advantage of the credit, wants you to benefit from the credit, so even high-income taxpayers will benefit from the child tax credit. Thank you for joining me for this short presentation. Remember, stay safe.